Then the owner will keep the remaining 24,890 in the company. That portion is called retained earnings. Okay, that's the portion of the earnings that is not distributed to the shareholders, but retained in the company. That's called retained earnings. Okay. Basically, you earn the money, net income, okay, and then you minus the dividend that is distributed to the shareholders. That equals net retained earnings. That's how much the earnings the company got retained, right? Okay, so I'm going to show you one example. So suppose there's one company, okay, in 2015, okay, they make $10,000, and they give the owner 2,500. Okay, so the company will retain the difference, which is 7,500. Okay, so it's retained in this container. Okay, imagine there's a retainer for money, so that's the retainer. Okay, and then the year after, 2016, the company makes 4,500, and this year the owner was taken 3,500 out of the company. So the difference is the retained earnings for that year, 11,000. So now in 2016, you have additional 11,000 retained earnings added to the pool. So in total, the balance of the retained earnings by the end of 2016 should be 18,500, right? Because at the beginning of the year, you already have a 7,500. And during the year, you add another 11,000. So your ending balance is 18,500. Okay, so then move to the third year, 2017. Again, similar procedures. So net income is 18,500, and the owner take 10,000. So difference is 8,500. That's retained. So that would increase the balance of retained earnings to 27,000. Okay. So by the end of 2017, okay, the company has a retained earning balance of 20,000. Okay, that is currently stays with the company. Okay, it hasn't been distributed to the owners yet. Okay, but it is the equity. It is the owner's money, right? It is owner's money. Do we have any questions on this retained earnings? Anyone? Yes. Okay. You understand it? Yes or no?
Yep.
Yeah. Okay. I will move on. Okay. So now let's take a look at the financial statement, the statement of changes in equity. Okay. Once again, you see that there are 3 line headings, right? So the first top line is the name of the company, and then this is the title of the statement. It's called a statement of changes in equity. And then you talk about the period, time period. Okay, this is for a time period ended for 1 month, ended October 31st, 2018. Okay, so for this statement, it's for a period of time. For this statement particularly, it's for a period of 1 month, from October 1st to October 31st, 2018. Okay. So the changes in equity, of course, you have 2 components. The common shares, that's the share capital, and the retained earnings, right? That's the 2 components for the equity. Okay, and then these 2 components add up to the total equity. Okay, so that's my columns. And then if you take a look at the rows, right? I always start with the beginning balance. That's the balance you have as of October 1st. And this is a new company, okay, as of October 1st. So all these balance are 0, right? You start with 0. And then the owner, okay, will put in $10,000, okay, $10,000. That's the share capital, okay? That's the owner's money. He put into this money out of his pocket, okay? And then during that year, that company makes how much money? Net income. That belongs to retained earnings, $11,042. Okay, that's how much money net income they make, and how much dividend declared. Okay, the owner wants to have that money to his pocket. 500. Okay, so the return earnings for that year, for the end of the month is 10,542. Okay, and then the common shares, that's the 10,000. Together, the total equity is 20,542. Okay, so when you first start a company, though, before you start a company, the equity is 0. Okay, at the end of the month, the equity balance is 20,542. Why? Okay, why is like that for the company? Well, the owner put into $10,000. Okay, the owner put into $1,000, and the company, okay, make some money for that month. Okay, and out of the money they make, they retained 10,542. So together, that's the total equity. 2,542 belongs to the owner. That's the total equity. The $500 is income for the owner. Okay, it's a dividend income for the owner. Okay, do we have any questions for this statement? Yes? No? No questions?
So is the shares...
Actually,
go ahead.
Go ahead.
Yeah.
Okay, thanks. Sorry, maybe my math is bad, but I was just seeing total equity 10,000 plus 11,042 plus 500 would be 21,542.
Okay. So there is a separation between the two entities. So your company is on its own is a legal entity, company, and the company has a name, right? The serial corporation. It's separated from the owner. Okay, it's two entities. Don't mix them up together. Okay. So think about Microsoft. It's a corporation. It's a legal entity, and Bill Gates is a separate entity. Don't mix up the two people, right? The two entities. So, so you can say that the $500 that was a dividend to the owner, right? So that's a dividend income for the owner. Okay. The net income for this company is $11,042. That's the net income for the company. And for the owner, okay, the income is 500. Okay, that's the dividend income. Okay, so of course this 20,542, that's the equity. That's at the disposition of the owner. Okay, whenever the owner want to have a dividend, want to get money out of it, the owner can declare a dividend. Okay, but the owner decided to keep the money in the company, as the company can use the money for further investment. Does that make sense? So it's company's money unless dividend is declared. Okay. As soon as the dividend is declared, that money is transferred out from the company to the owner. So
thank you. That makes sense.
Yeah, they are not together. They are separate. Okay, they are two different entities. Good question. Yeah. So anyone else?
So the issued common shares, I'm just trying to understand more what that is. So that's like the amount of shares they sold, or how many shares they got back from selling?
Okay. Yeah. So the common shares is when you first start a company, right? Let's say you start a Tyler's incorporation, right? So what happened is you would put into money into the corporation in exchange for the ownership, right? Just like you buy shares in the stock market, right? You pay money and you acquire some shares. That's the symbol for the ownership of the company, right? So when you start your own company, it's kind of the similar idea. You have to put the money into the company, okay, in exchange for shares. That's what we mean here, issue the common shares. The company issued the common shares to the owner, okay, for $10,000, okay. The good thing is here, you can issue yourself like a million shares, right? You can set up the price of each share. But if you go to the stock exchange market, the price is set up by the market, right? So you are saying, right? I can set up like $1 per share. So I can issue 10,000 shares at $1 per share. Therefore, you give $10,000 to the company. Hopefully, you would grow the company, and then your company will worth lots of more money, right? And then their share value will go up. It can increase from $1 per share to $100 per share, and that's the time you became a millionaires, right? You had to grow your company, right? You had to grow your company to make it, worth, right? To make it worthy. Okay.
Yeah. So
Okay.
that 10,000 is coming from somebody investing in the company and buying shares.
Yeah. So you would hire a lawyer, draft like legal kind of articles of the incorporation. In that document, it will be very clear stating how many shares has been issued.
Gotcha. Okay.
Yeah.
Thank you.
No problem. So anyone else? Any other questions? No? Can I move on?
Yes.
Okay, thank you. Okay, so now changes in shares. Okay, so you always have for all these different accounts, you always have an opening balance. Okay, and then you add the addition. That's the issuance of the new common shares. Okay, and then you minus the common shares the company has bought back. Right. So then that's your ending balance of the common shares. Right. So if you start with $10,000 common shares, okay, next year maybe your friend want to join you with this venture, right? Your friend wants to be a owner too. So then the company may issue another $5,000 worth of shares to your friend, right? So that would increase the common shares to be 15,000, right? And then maybe the company will buy back shares from you, right? So maybe you would sell the $10,000, maybe half of the $10,000 back to the company. Then you minus, 5,000, right? Your ending balance would be 10,000 plus the 7,000 new issuance to your friend, and minus the 5,000 bought back from you. So now your ending balance will be 5,000. Right? That's how the changes in the shares. And then for the return earnings, okay, for the return earnings, you have an opening balance, and you add net income. That's the money you make, but then not all this money are retained, right? You may issue a dividend. You don't have to. Okay, you don't have to declare a dividend to the owners. If the owners doesn't need money, the owner decided to keep all the earnings in the company, right? So, and then if in a situation there is dividend declared, so you subtract the dividend because that money goes to the owner, does not stay in the company. Now you have ending balance of the return earnings. Okay, so that's the changes in the return earnings. Okay, do we have any question on this?
That sounds good.
Okay, awesome. Okay, let's work together on page 34, BE 1-10. Okay, so I'm not sure if you can see it, just in case you don't have your textbook. Are you able to see this? Oh, it's quite blur.
It's kind of blurry.
Okay, how can I do this? Let me take a look. Just give me 1 second. I'm just wondering if I can make it a How about now? Is that better?
That's better.
Yeah, that's better.
Okay. So if you have your own ebook or textbook, please work on this question, BE 1-10. I'm just holding this textbook for you, and so just in case you don't have it. it. Wondering if I move it a little bit here. Is that better? So this is the Go Ahead Limited that began the year with common shares, that's opening balance, 100,000, and the return earnings for 75,000. During that year, it issued additional 50,000 common shares, reported net income 75,000, and declared a dividend of 15,000. So A, calculated ending balance of the common shares and return earnings. And 3, total shareholders' equity. Okay. B, explain how your answer would change if the company has reported a loss of 75,000 rather than net income, not declared any dividend. Let me know if you finished. Okay, did anyone have an answer for this? What's the ending balance of the common share?
Is it 685,000?
685,000. How did you get that ending balance? You mean the total shareholder equity?
Yeah.
Oh, okay. Do you mind just taking me one step by step? So
Oh,
what's your ending balance for the common shares?
150,000.
Very good. And what's the return earnings balance?
What's hold on a second. Because we started with 475. We got 75,000, but we have 15,000 dividends we gave out.
Yeah.
So do I not include shares when I'm calculating the retained earnings?
No, because they are separate components of equity.
Okay.
Yeah.
That's where I messed up then.
Yeah. So I'm gonna do this together with you. It's quite straightforward. If you go, I will go back to the the PowerPoint. Okay, so basically the ending balance of the common shares, okay, that should be, let me see here, I do annotation. So that should be the opening balance 10,000 plus the new issuance of common shares 50,000, so 150,000. Return earnings should be opening return earnings. That's the 475,000 plus net income 75,000 and minus dividend 15,000. So that equals 535,000. Okay, and the total would be the two numbers together. So that should be 685,000. Is that right? Okay. Does anyone have any questions on this? Can I move on?
Yeah, that makes sense now.
Okay, good. Awesome. Okay, I will move on. Okay, so for the statement of changes in equity, okay, so from this statement, you would know, okay, what is the changes in the common shares, right? That's important. Common shares representing ownership, right? And then you want to know how much money is distributed to the owners. That's a dividend. You're gonna see the dividend amount. Okay. Some investors would like to have dividend, right? If they invest into a company, they wish to receive some annual dividend, right, on a periodical basis. Then you want to know, okay, what is the changes in return earnings? Okay, the corporation, if they're healthy, okay, they probably would have a stronger return earnings, right? They are building wealth, right? They keep more money over the time. Okay? If you realize that company's return earnings is going down, then you are concerned what happened, right? Is the company at a loss position? Does the company issue too much dividend to the owners, right? So you always try to keep that return earning balance, right, at a positive balance, right? You don't want this to be a deficit balance, right? Okay, so basically you are concerned. You hope the equity should be increased, right? If the company's equity decreased, you have to be careful, right? You have to understand what happened. Okay. Okay, the statement of financial position. Okay, the statement of financial position has three major components: assets, liabilities, and shareholders' equities. Okay, so in my bottle company, right? So my assets is that bottle. Okay, that cost that value is $100. My liabilities are my loan from the bank. So that's the $80. Shareholder equity is the money I put in, the common share, worth $20, right? So you can see the total asset equals 100. That equals 80 plus 20, right? So this is the accounting equation, right? That's very, very important, the balance equation. So your asset always equals to liability and shareholders' equity, right? That's pretty clear, right? So you need the money to buy an asset, right? So where the money comes from, it either comes from your pocket, that's the equity, or from the creditor's pocket, that's liability, right? And then you use this money to buy the asset, right? So liability plus equity has to equal to the value of the asset. Does that make sense? Okay. Think about where that $100 I get from to buy that bottle, right? It's either from me, right, or from the creditor, right? And together, right, the combination of the two has to equal to the value of the asset. So asset equals liability plus shareholders' equity. Does that make sense? That's the balance equation. Okay, so that's very important. Does this make sense?
Yeah.
Yeah.
Okay, so what is assets, right? On the Moodle website, there are some YouTube videos for you to watch. I think that guy did a great job in explaining what is asset. Okay, so basically, asset would have three major criteria in terms of the definition. So it has to be owned by you, right? So if the bottle owned by you, right, that is not my asset, right? Okay, maybe I rent it from you. Okay, I don't have asset because you own it. If it has to be a past transaction, okay, on certain date I paid for $100, I acquired the asset. That's a past transaction. It's not about, oh, tomorrow I'm going to buy it, right? So then it's not your asset. You can't put it on that statement yet. It's not your asset yet. Right? It has to generate future benefits. Okay. Okay. So So think about the bottle, right? You know, I have. Every time you drink from it, I charge you $1, right? Because the water from this bottle will make you smarter, right? So, you know, that's the future benefit, right? Every time people use it, right? My customer use it, I have a future benefit of that, right? That's the I side, okay? And liabilities, I think it's quite straightforward. That's the owing, right? It's the legal obligations of payment you have to make in the future to the creditors. And shareholders' equity, that's basically shareholders' money, right? Shareholders' money. Okay, so that's the three major components: assets, liability, and the shareholders' equity on this statement. Okay. Okay, so in this case, we have liability 5,000 and equity 5,000. What's the value of the asset? So 10,000, right? So your liability and equity together, that's your asset, right? So the total asset of the company should be $10,000. Okay. So let's take a look at this statement. Okay. Here is an example of the statement of financial position. We also use the term balance sheet. Okay. So the statement of financial position, that's the terminology under the IFRS. Okay. So as you can see, similarly, you have this 3-line headings, right? Name of the corporation and the title for the statement. This is the statement of financial position. And then here for the timing, this is very unique for this statement, right? This is a snapshot. It's not for 1 month or for a year. It's not for a period of time. It's for a specific time, okay? It's not a motion, it's a position, okay? If you think about the other two statement, income statement, statement of changes in equity, the two ones we just introduced, they are, if you think about it, that's a motion, right? So for a period of time, okay? So this statement, statement of financial position, is like a snapshot, okay? You take a picture, right? It's a position, okay? So on October 31st, from this information, I know the company has a cash of 11,400. Okay. So on October 1st, how much cash do we have? I don't know. I don't know how much cash they have at the beginning of the month. All I know here is on the day of October 31st, okay, they have a cash of 11,400, right? The balance of the cash is dynamic, right? Every day you maybe receive some money and you spend some money, right? So the balance is changing every day. Here, the information is really only about 1 day. That's October 1st, October 31st, 2018. Does that make sense? It's not for a period of time, okay? It's for a specific time point. Does that make sense?
Yeah.
Okay, awesome. From this information, you can see the total asset, okay, is 29,067, okay, and the total liabilities is 8525, and the total shareholder equity is 2542, okay. So and the liability plus equity equals asset. If it's not, something's wrong with that statement. Okay, the accountant must have did something wrong. So this has to be balanced. Okay, this has to be balanced. That's how we got the other name, balanced sheet. Okay, the balanced means asset equals liability plus equity. Okay. So what do you say about this company? Do you think this company is quite strong? Think about, you know, the proportions of the debt and your own money, right? So you don't want to have lots of debt, right? Right. Here, right? You know, out of this asset 29, 20 belongs to the owner, only 8,000, close to 9,000 to the bank. So that's good, right? You don't want have a significant percentage of debt, okay, in the company, right? Okay, and for assets, let's look into the section for the assets. Okay, you can further categorize them into two groups. One is called current assets. The other is called non-current assets. Okay, that classification is based on basically their operating cycle of life. Okay, so anything can be converted to cash within 1 year or within the shorter time of 1 year of their operating cycle. Okay, those are the current asset. Okay, so for example, cash is already cash. You don't have to convert it to cash. Okay, for account receivable. Okay, this is the money your client owes you, right? So you know this is account receivable from your client. Okay, so basically, you sell your client items valued $100. Okay, the client only have $20 cash. Okay, so they pay you $20 cash, and they promise you to pay you back the other $80 within 30 days. Okay, okay, so and then on that day, okay, your account receivable balance should be $80, right? So 30 days after, okay, when the client pay you the $80, and that becomes cash, right? So you can see that this account receivable will be likely to be converted to cash within 1 year, right? So that makes it to be a current asset. So how quickly you can convert it to cash, okay? So similar ideas for inventory. Think about you go shopping at a superstore, right? And all the items displayed on the shelves, those are called the inventory items, right? So when you buy a bag of rice, okay, so I'm from Asia, okay, we cannot live without rice. So if you buy a bag of rice, okay, and so then the minute you check it out at the cashier, right? So then what happened is the superstore convert that inventory to cash, right? So you take away that inventory, okay, their inventory level go down, but they receive the cash, right? Hopefully, you know, this inventory will not be there for too long. Otherwise, maybe it will be expired, right? It cannot be sold anymore, right? So inventory is considered as a current asset, right? Current asset. And then supplies, right? For universities, we use a lot of papers, right? We use a lot of papers, markers, right? So that's just our supplies, right? That's just our supplies. So those are the current asset. Those are the current asset. Okay. So you may not see the benefit like converted to cash right away, but every semester we probably run out of lots of papers and markers. Okay, but there's the benefit, right? Indirect benefit is we use these supplies in order to make money. That's your tuition, right? So again, you can see, right? This is the asset. Okay? Without papers, markers, we cannot make money, right? I cannot just simply talk, right? Sometimes I have to use the markers. Write down. Before the COVID, you know, we use the papers so that you can write your exams, right? So okay, and the prepaid expenses. So that's about the subscription, right? Think about, you know, you on July 1st, you prepaid for 1 year subscription license of a newspaper, right? You pay suppose $12, $1 per month on July 1st, right? For the whole year, you paid at one time, right? At the end of the year, right? Suppose it's December 31st. That only 6 months elapsed, right? Only 6 months elapsed. Okay, so you still have how much money left on that account? You paid $12 for the whole year. So at the point of reporting this information, 6 months has passed. What's the remaining balance for the prepaid expenses?
$6.
$6, right? Because every month, there's $1 subscription expenses. Okay, so you still prepaid for the next 6 months. You haven't received the subscription yet. Okay, so this is your asset, right? That's your asset. So what are the non-current assets, right? Those will be the long-term investment. University built a science center, right, on the on the Lethbridge campus, right? You think they will sell it right away to another party to convert it to a cash within 1 year, right? They won't, right? They won't. They are using this long-term asset for long-term benefit, right? They're gonna use this science building for many, many years ahead, right? And the benefit would be students pay the tuition, government provide the grant, supporting grant, right? So basically, that asset will be there for many, many years, okay? It will not disappear for within 1 year, right? Okay, so you can see that, this would be the kind of the further classifications. Current asset versus non-current asset. Intangible assets. This is something that are valuable to your company, but you cannot touch it, right? Think about the software, right? Think about the software. That's something a software company, right? Think about the software companies. So they came up with all these like Adobe, right? Different softwares for AI, for premium, for video editing, for like Photoshop, right? All these different softwares, right? These programs, you cannot touch it, right? You cannot touch it. It's intangible, right? But it brings money to the company, right? It's an asset, right? And they can bring monies to the company not only for 1 year, for many, many years, right? Okay, so this asset is there around for many, many years. Bring benefit, economic benefit to the corporation. So that's the intangible asset, right? Non-current asset. Okay. Do we have any questions on this?
So wouldn't supplies be more of like kind of like an expense though, because you're gonna have to keep getting new ones all the time?
Yeah. So the one you have used, that's your expenses. The one you haven't used it, right? That is your supply asset.
Okay.
Yeah. So if in a year, right, you buy, let's say you buy supplies, cost you $100, and so you only used half of it, right? So your supply expenses will be 50, okay, and then your supply asset, whatever left is your asset, that will be 50. Does that make sense?
Yeah, thank you.
Anyone else have any questions about this topic?
Nope.
No? Okay. Now, similar ideas for liability, right? What's the current liability, right? If I think about utility bills, right? Normally, I would pay off the utility bill balance within maybe 1 month, right? Because you don't want to have your gas line cut off in the middle of a cold winter, right? So you want to make sure you would settle these liabilities to the utility company within relatively quick time, right? Those are the account payables, right? So the university probably will pay all these suppliers, right? Electricity, gas, all these kind of different services they are using, okay, on a monthly basis, right? So they would settle these liabilities within 1 month. Those are the current liabilities, right? Within 1 year, right? Those are the current liabilities. What would be an example for long-term liabilities? So if you have suppose the university borrowed $2 million from the RBC Bank to finance the science building construction, that's $2 million. University cannot repay that whole balance within 1 year, right? It's gonna take universities 20 years to pay it off, right? So that's a long-term liability. So that liability is gonna stay on the balance sheet for more than 1 year, right? Okay. personally think about your mortgage, right? If you own your own house, right, you probably have a mortgage of 30 years, 35 years, okay? Those are all your long-term liabilities, right? I really wish I could have my mortgage as a current liability, right? That means I will be like make millions of dollars a year, right? So I can just pay it off in a year, right? So CEOs, maybe they can, on their own balance sheet, the CEOs probably will put the mortgage liabilities as a current liability. None of us can do that. Okay. We talked about the shareholder equities, the two components, the share capital and the return earnings. Right? So this would be the general view of the statement of financial position. Okay. Do we have any questions on this?
So is share capital the same as dividends, or what? What is that?
Dividend is the money received by the owner, right?
Right.
Again, this balance sheet is not about the owner; it's about the company.
So what's share capital then?
Share capital is the how much the owners has paid to the company in exchange for the shares. So the owners, shareholders, has to pay the company to obtain these shares, right? So the balance of share capital shows you that how much money the owners has paid.
Like how much they sold the shares for.
Yes, yes.
Gotcha. Okay, okay.
Anyone else? Any other questions?
Nope.
Can I move on?
Yeah.
Okay, I see there are two. Share capital is the collective accounts of shares, right? Yes. I have recorded a lecture. Yes. I have recorded a lecture. Okay. Awesome. Yeah, so things can get more complicated, right? For this introductory financial accounting, just to consider there are two components. Okay, when you move to the intermediate financial accounting, okay, you have lots of to learn about about equities. Okay, but for the purpose of this course, just to know that the two major components are share capital and the return earnings. Okay, so I will move on. Okay, so we talked about the current asset. Okay, so they are expected to be converted to cash. Okay, sold or used. Okay, in the business within 1 year of one operating cycle. Okay, whichever is longer. Whichever is longer. Often we are going with the 1 year standard. Okay. So here, let's take a look. You can take a look at here, all these different accounts that are current assets, right? Cash, it's already cash. Held for trading investment. So these are the investment the owner, the company has no intention to hold it for long term. So they are ready to trade it anytime, okay? And there is active market. They can trade it within like, a few days or maybe within 1 month, right? Okay, so that's the held for trading investment. That's the shares or bonds, right? Whatever the investment the company is holding, that can be easily converted to cash within a short period of time. Accounts receivable, inventory, supplies, prepaid insurance, right? These are the things I have mentioned. Okay, I already mentioned. Non-current asset, okay, non-current asset. These assets are not expected to be converted to cash, okay, within 1 year. So the examples will be your land, buildings, okay, vehicles, equipment, right? You do not throw away your computers, right? 1 year after, right? You're gonna use it for at least maybe 2 or 3 years, right? Okay, if you have a good job, you probably will replace your computer every three years. Vehicles, right? All these big purchase items, you are very likely to use it for long term, and these assets will generate economic benefit to the corporation over multiple years. This will be all non-current or long-term assets. So then, okay, you know, how are we going to recognize the cost of using these assets, right? So the building, let's, for example, maybe the University Science Center cost $20 million. I don't know the actual number. Let's just assume that it cost the university $20 million to build, okay? And then, okay, and then the buildings will getting older and older, right? Okay, and maybe it can be used for, I don't know, 30 years, 50 years, 100 years. Eventually, maybe it will be useless, right? Eventually, it will be useless. So how are you going to recognize the cost of using this asset, right? So with the building, right, we have students, right, studying, taking lectures in that building, right? They pay tuitions. You definitely see the benefit of having the science center, right? How are you going to recognize the cost of running these buildings, right? The buildings are getting older, right? You know, the paint, right, faded, right? Carpet became weared out, right? So hopefully structurally everything is solid, concrete. How are you going to recognize the cost of using the building? There's a cost of using the building, right? How are you going to do that? Okay. So basically, we call it depreciation. Depreciation. Okay. So suppose the building will be around for 30 years, right? So initially, the building's value is 20 million. Okay. Suppose at the end of 30 years, the building is worthless. Okay. The building is worthless. So it's $0, right? So the value has decreased from 20 million to 0 over 30 years. Right? Okay, so that's the cost to university. Right? So how are you going to recognize this cost? It's called a depreciation. So you're going to recognize the cost of using the building, okay, every year. Okay, because you use the building every year and you receive tuitions every year. Okay? So you're going to recognize the cost every year. So we have to match the cost against the revenue. So the depreciation expenses added up over 30 years should equal to 20 million, right? That's the depreciation. Okay? Does this make sense? Okay. If the first year, if I just do a straight line, okay, just for the ease of calculation, suppose the building is 30 million, right? 30 years. If I just do a straight line amortization, so every year I recognize 1 million, right? Every year I recognize 1 million. Over 30 years, I recognize a total of 30 million, right? And so the value of the building is 0, right, by that time. Okay? So what's the cumulative depreciation? Okay? So you have account, you have one account, okay? So this account will keep track of the total amount of depreciation you have recognized so far. That's called the cumulative depreciation. Okay? 2 years after, what's the cumulative depreciation? Anyone? 2 years after, what is the cumulative depreciation?
The depreciation from both the first and the second year.
Yeah, so that would be?
I don't have the numbers down
Yeah,
here,
2 million,
sorry.
right? So if one year is 1 million, for 2 years,
Oh,
that would
yeah.
be 2 million, right? Okay.
Yeah.
So now what's the carrying value? Carrying value is the difference of the cost minus the cumulative depreciation. Okay. So the 30 million is the cost. 2 years after you recognized 2 millions in total, that's your cumulative depreciation. So what's the carrying amount right now?
28 million.
28. Thank you. Very good. Okay. Very good. Does anyone have questions on this?
Nope.
No? Can I move on?
Yep.
Okay, good. Okay, so let's take a look at this. Okay. So this is the asset portion of financial position. Okay. So you can see the total asset is 151,400. Okay. And then you can see the two groups current asset. The total current asset is 22,100. And you can see the long-term asset, long-term investment, 7,200, and the PPE, property, plant, and equipment, 119,000. Okay, and the goodwill is 3,100. I'm going to talk about goodwills in the future lectures. Okay, what is goodwill about? Together, add up together to be the total assets. Right. So I want you to pay attention here. Land. Okay, what's the value of the land? 40,000, right? Okay, so but can you see the cumulative depreciation under land? Is there a line for the cumulative depreciation under land? No, right? You didn't see it. So normally we do not depreciate land. You know why?
Because it's just dirt.
It's dirt. Yeah. Can you worn out land? You can worn out carpet, right? Can you worn out land?
No.
No, right? So you think about agriculture, the land will grow crops every year, right? It won't end it, right? The land is always there, right? Right? So, so land, you do not depreciate land. Okay, so this balance here tells me that this company paid $40,000 to purchase the land initially. Okay. Okay, and here if you move on to see the buildings, okay, see the buildings. Buildings 75,000. This tells me that the company paid $75,000 initially to buy this building. Okay. How much the building is valued at now?
60,000.
60,000. That's the carrying amount, right? Carrying value. Why? Why it's lower than the original cost, 75,000?
Because it's depreciated.
Because it's depreciated, right? So you recognize that over the time when you use the building, the value of the building will decline, right? Because the building will be, get old-fashioned. Maybe you don't like the style anymore, right? You know, with the young generations, right, moving up to be the mainstream of the society, they don't like that building style, right? Just for that, it won't work that much, right? And not only of that, if you want to use the building, right, the wall, paint, right, whatever you crack on the frame, so many things the building is just, I mean, the building is most valuable when it's first constructed, right? We won't have any question about it, right? And so this tells me that over the time, since you have the building up to this point, October 31st, in total, you recognize the depreciation expenses, 15,000, okay? It could be 1 year, 2 years, 3 years. In total, you recognize 15,000. Okay? It's really depending when you purchase the building. Okay? So similar ideas for equipment originally cost you the original cost, 24,000. Over the time, you recognize a cumulative depreciation of 5,000, and on October 31st, on that day, you are saying that my equipment value is 19,000. Do you have any questions on this?
So wouldn't like a vehicle like depreciate faster than a building?
Yes, very good. Yeah. So in the future, we are going to learn about depreciation methods, right? So there are different ways to calculate the amount of the depreciation, right? Depending on the type of the asset, right? So you are right. Like computer, usually is depreciates faster because technology advanced very rapidly, right? You know, the computer you bought as a cutting edge computer 3 years ago became really obsolete, right? In today's technology. So for buildings, right, this would generally maybe have like 30 years useful life, right? It's gonna depreciate slowly, okay? The point is, the longer you can use it, it's gonna be depreciated slower, right? Anyone else have any questions? Can I move on? Okay, good. Okay, so similar ideas, examples I gave for the current liabilities are bank loans, right? If you borrow some money, so maybe you paid back within a year, those would be a short-term bank loans. Okay, your student loan, I won't consider it as a current liability. Okay, so I suspect that you're gonna first have to finish your degree. Okay, that's maybe take you another 3 or 4 years, right? And once you get a job, you start paying your student loan. Maybe that's another 10 years or I don't know, 50 years. So that's student loan probably will be a long-term liability, right? Okay, so unearned revenues, right? What is unearned revenues? So suppose I'm the best teacher in accounting, right? You decide to hire me as a tutor, okay? So, but I'm too busy, right? I'm booked well ahead of time, right? So you book me for my service in 2022, okay? And you pay me, $20,000 now, okay? You pay me $20,000 now, so that you are reserved for a spot in 2022 next year, right? So I received your money, you give it to me, right? So I debit the cash, right? I have cash. But at the same time, okay, I have a liability. I haven't done any work for you yet. So at any time, you can get money back, right? All of a sudden, maybe you dislike me, right? You're saying, guess what? I don't like your glasses, right? And then, you said, well, I demand a refund of $20,000. Guess what? I have to give it back to you, right? So that $20,000 is a unearned revenue for me, right? So if I tutor you, right, I make that $20,000. That's my revenue, right? I earned it because I delivered my service, right? And you are happy. You learn a lot from me, right? But since that's just a plan for 2022, I haven't done anything for you yet. The fact you give me the money, but it's not my revenue, it's my unearned revenue. And unearned revenue is not my money, it's your money, but it's sitting in my bank account. So therefore, it's a liability. Whenever you demand it back, I have to give it back to you. So that's a liability, right? Unearned revenue. Okay. Okay, so if you take a look at here, some other accounts under the current liability, salary payable, right? Boy, I'm really happy salary payable is a current liability, right? Can you imagine if salary payable is a long-term liability? Like university will not pay me 1 year after, right? How am I going to survive, right? How am I going to live, right? So usually salary payable would be cleared every month, right? Interest payable, right? Maybe you have to pay the bank interest either monthly or semi-annually or annually. Those will be your current liability, right? If you don't pay the interest, within 1 year, maybe they will call for the repayment of the full amount, right? Unearned revenue, I talked about it. Bank loan. Oh, current portion of mortgage payable, right? So the next 12 months, the next 12 payments from now would be considered as a current liability, right? That's the liability you have to settle within 1 year, the 12 months. So your next 12 mortgage payment, okay, that's considered as a current liability because those payment has to be honored within 1 year, right? The liability. So for long-term liabilities, if it's monthly, based on monthly, you can separate a current portion versus a long-term portion, right? So the current portion of the mortgage payable is a current liability. Does anyone have any question on this? Am I going too fast, or you are okay with the pace?
It's pretty good.
Good. Anyone else?
Yeah, it's good.
Yeah, it's good.
Okay, awesome, awesome. I appreciate some feedback, right? Because I don't know if I'm being too slow or being too fast, right? It's really depending on your response, right? If you realize, oh, I have explained enough, it's pretty clear, and then, you know, that's good, right? But if you feel that you are not following me, then let me know, right? I'm gonna slow down, okay?
Okay.
Okay, so non-current liability, I give you the examples of, you know, long-term bank loan like mortgage, lease obligations. Sometimes you may lease a car, right, for 5 years, 6 years. Okay, that's your long-term obligation. Pension and benefit obligations. So universities provide very good pension plans for us. Okay, of course it's long-term, right? Because you know, this is the liabilities they are going to settle when I'm really old, right? Okay, so they are not worried about paying me pension now, right? Okay, so this is a liability they are going to worry about once I'm retired, right? And after my retirement, university is liable to pay me a pension out of my account, right, every month. So this liability is of course a long-term liability, right? So if I live up to 150 years, boy, universities have many years to pay to me, right? So that's going to be a big obligation for them, right? So pension and benefit obligations, these are the, you know, apparently there's long term, right? Okay. So the only thing I want to mention from this slide is you can take a look at, okay, the mortgage payable, okay, mortgage payable, so has two components. The long-term components is 10,300. That's under the long-term liability. And they also have a current portion of mortgage payable. That's 1,000. Okay, so that is the liabilities within 1 year, right? Within the next 12 months. I hope it makes sense. Okay, we talked about the shareholders' equity already. Two components: share capitals, that's your investment to the company, and the retained earnings, that's the cumulative earnings retained by the company, right? Okay, so here the share equities. Okay, share equities. Oops. Has two components: common share 74,000, return earnings 50,050. Okay, total shareholder equity is this the sum of the two numbers, 124. Okay. Now pulling everything together. Okay, so you have this statement of financial position. Remember, this is on a particular date, October 31st, 2018. What the information look like on October 30th? I don't know. Okay, one day these numbers can change a lot, right? What is the information look like on September 1st? I don't know. Okay, this information only tell you their financial position on October 31st. Okay. So now take a look. Your asset, total asset, your total liability. Okay, total liability is 27,350, and your total equity, okay, 124,050. So total equity and liability, okay, that's 151,400 equals total asset. Okay. So in this picture, you can see the asset is 100%, the full circle. The equity is the orange color, and the blue color represent liability. You can see for this company, right, they only have a small portion, like even under 20%, maybe other liabilities. That's good. It's pretty safe. You don't have too many debt liabilities. Okay, let's take a look at this question. BE 1-8, page 34. Okay. Page 34, BE 1-8. Okay, just for the benefit of the, I hope eventually you're going to have your textbook. Just for the benefit of those of you who do not have textbook, I'm going to share my document camera here. Which question we are talking about? BE 1 dash, which one? No?
-8.
8? Okay, here. So in this question, indicate which one of these items is an asset, liability, and all shareholders' equity, okay? So let's talk about this. A, bank indebtedness.
Liability.
Very good. Current or long-term?
Long term.
Bank indebtedness is often the bank overdraft. So
Correct.
it's a short term. This one is tricky. Yeah. So B, accounts receivable.
Oh, that's an asset.
Long term or short term?
Short term.
Sorry, I should say current or non-current.
Or sorry, current.
Yeah. Okay, thank you. Salary payable.
Liability.
Current or non-current?
Current.
Okay, good. Accounts payable.
Current liability.
Thank you. Inventory.
Current asset.
assets.
Okay, thank you. Equipment.
That'd be a current asset.
Equipment. So how long do you think you are going to use the equipment?
Well, that might be a long term then.
Yeah, very good.
Yeah.
Thank you. Long-term asset, right? Non-current asset. Goodwill. Let's skip this one. Okay, let's skip the G. Common shares.
Isn't goodwill an assets?
Yeah, goodwill is a long-term asset. Yes.
Yeah.
Common shares.
Equity.
Come on,
Equity.
go ahead.
Shareholders' equity.
Yes, very good. Current or non-current?
It should be non-current.
Okay, so I'm just sorry. I was trying to trick students. So there's no non-current or non-current, right? So current and non-current is only for asset and liability. There for equity is just equity. There's no current or non-current. The money is always your money, right? The money is always your money. Does that make sense?
Yes.
Yeah. So we do not classify equity as non-current versus current. Okay. We only do that for asset and liability. Okay. Bank loan payable.
Long-term liability.
Okay. Good. Return earnings.
Equity.
Okay. Shareholder equity. Cash.
Current asset.
Yeah, thank you. Current asset. Okay, so that's our practice. I hope it makes sense. Okay, just give me 1 second. Let me share my screen. I wish that the easier way for me to switch the two PowerPoint and document camera. Okay, so we are okay with this question. It's pretty straightforward.
Yep.
Okay.
Yes.
Awesome. How are we doing with time? Oh, we are almost. Are we? We only have 1 minute, right?
Yeah.
Okay. Okay, so how much? Oh, I still have quite a bit of slides here. Okay, so for the statement of financial position, okay, it answers what are the assets, right? What's the liability? What's the equity? Okay. So basically, you want to know, is the company heavily leveraged? That means a significant higher percentage of debt. You have like 90% of debt, right? That's probably not very safe to invest into a company, right? Okay. So for the assets, if you compare this year to last year, you can see, oh, did they purchase a new land, right? Did they purchase new buildings, equipment, right? Are they expanding, right? Those are all informations you can learn from this, right, statement of financial position, right? Okay. So next on Wednesday, we are going to talk about the last financial statement, the statement of cash flows. Okay. So do you have any questions? So class is dismissed. It's the time. And if you have any questions, you can stay around and we can talk about it. Okay. Have a nice day, everyone, and good luck
Thank
with
you.
your study.
Thank you.
Thanks.
Yeah,
Thank
thank
you.
you.
Thanks.